please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. We are covering the budget for you from all angles. We have our market experts and corporate experts with us, taxation experts with us. The budget so far, in terms of the market movement, one has to say, has lived up to, expectations. Wild moves already seen, big sell-off during the course of the budget, especially the last 15-20 minutes, and then a big takeoff from there. The Nifty is up 62 points or so right now. So even though the long-term capital gains tax has found mention, so far it's kind of failed to dampen enthusiasm. Our guests are with us, so let me just actually put a couple of questions. Okay, I think we have, let me go first to Ashok Vadva. Ashok, just a quick question on the market reaction per se. Are we missing something here? Or, the market is not really bothered with this long-term capital gains and the fiscal deficit, as Lata was talking about?
I guess the market was expecting worst. And in that sense, since the finance minister has grandfathered all gains up to 31st January and lived up to the commitment that he made that he will not make retroactive amendments. Because remember, if he had not grandfathered it, it would have effectively been a retroactive amendment. You would have been taxing income which was otherwise not subject to tax in India. But having lived up to that commitment, I think the market, having budgeted some element of tax, has already kind of built it into its mind and is moving ahead. There is, as time settles down, market will realize that there is a duplication between STT and capital gains tax. Not only that, the worst thing is that you don't even have an indexation now. Yeah. At least until now, you had indexation, and the finance minister, as I heard him, I haven't read the fine print, said that there is no indexation. So in that sense, as time lapses, market will find this to be a little more expensive than the first reaction. And perhaps at some stage, it'll show some impact on the market. But listen, we are in a bull run. There is so much liquidity. Corporate earnings are showing up. Economic recovery is there. In that sense, I think the finance minister has timed his introduction of capital gains tax well. A liquidity-driven market, an economic recovery, and corporate earnings moving to double-digit. Perhaps augurs the best time if there was a time to introduce capital gains.
All right, thank you very much, Ashok Vadva. We've got Vallabh Bhansali as well joining in. Ashwini Agarwal of Ashmore is with us, and Vetri Subramaniam of UTI Asset Management is joining us in just a bit. Mr. Bhansali, thank you very much. Your first thoughts, sir, two things that could have disappointed the market: capital gains tax, but coming grandfathered, and a higher than expected fiscal deficit.
Well, the market doesn't seem to suggest that it is disappointed at all. It took some time to understand, but I think when you are getting a grandfathering mechanism at the highest market ever been, what is there to complain? And after the data that came out, that 3.67 lakh crores was the exempt income on account of long-term capital gains tax, at a time when everyone is paying GST in the country, a 10% tax is neither here nor there, and the market correctly has just moved on. From that point of view. So, and on the fiscal deficit, I think one needs to understand that a country which had introduction of bank recapitalization and GST and was absorbing the slowdown caused by demonetization, to be able to contain the deficit at around 3.5% last year and projecting 3.3 next year, I think in a developed economy is I think absolutely fine. And the bond markets as well as the equity markets seem to have absorbed that well. So I am extremely excited about the budget.
And do you think that the cheer in the capital markets will continue? You think inflows into mutual funds will continue despite this overhang of tax? Or do you think now debt gets more attractive?
So there's a knee-jerk reaction. One will have to read all the fine print, and because the way tax will be computed will take some time to understand. But the budget will not have made any impact on whatever was happening. So we go back to fundamentals. We will get used to that there's a 10% tax. I've seen enough markets where taxes come and go. As long as the fundamentals are strong, people still do business, people still make investments, money will continue to go into mutual funds. That as an asset class has come to be established. 10% tax is a completely non-event according to me.
Mr. Bhansali, so that is the tax part, but what about the bit about the fiscal deficit, the spending? I mean, Lata was talking about possibility of what the RBI may do. Is that something to worry about? Or, I mean, the market is rightly showing us a reaction that it's not worried, and we should not be.
So in an election year, I mean, your fears can be much worse. That, what sort of populism will come in, what sort of subsidies, etc., will be given out. So here, I think if you see that a very systematic approach to spending at the ground level and farmer support has been made, that, I mean, can we take jobs, can we take clusters, can we take infrastructure, etc., all together, and use that to push the demand in the economy, which has been the major problem. Why our investment cycle is not getting pushed is because our capacities were not being utilized. And they can't get utilized till demand comes up. And the demand in India doesn't come up until the rural sector, agricultural sector comes up. So I think you needed to put money there, as you already created a very powerful incentive for the formal part of the economy through GST, etc. So I think everything is just falling into place. So I think given all of that, the slight alteration of the fiscal path to 3.3%, and if you ask me, I expect that I think that the finance minister may have been a little probably aggressive in estimating 20,000 crores as from capital gains tax. I don't think it'll end up that much there. But I think we will make much more on direct tax collection and on GST, and therefore the 3.3 will be well contained, is my estimate, and I think the bond markets also seem to think so. Therefore, I think world over you will find experts accepting this number and appreciating this kind of budget.
We are going to reach out to many of them, sir. Thank you very much for joining in and giving us your first thoughts, Mr. Bhansali, on the budget. Speaking of course, global reactions, we have got one foreign fund representative here. Ashwini Agarwal of Ashmore is with us. Ashwini, if you put all the macro numbers together, do you think this is still attractive for an equity investor?
Well, the valuations aspect have been stretched for a while, so that concern the budget has nothing to do with. From a longer term perspective, I think, if you just read through the first part of the finance minister's statement, where he's speaking about rural India, where he's speaking about infrastructure, where he's speaking about health insurance for the poor, which is, I think, a very, very powerful and much needed support that the poor people need. And he's talking about efficacy of education, the outcome-based measurement of education. I think this is what the new India needs. So I think from that perspective, as a watcher of, India for a long period of time, this is very refreshing to have these this kind of thinking. I mean, it will take time, obviously, to translate into an effective change in the management of a lot of government institutions.
I take your point. You can't throw numbers when there is such genuine rural distress. But, your former colleague, Vetri Subramaniam, is with us. Vetri, how are you looking at it? Do you think incremental inflows into equity markets, especially into mutual funds, could be affected? Do you see the scepter of interest rates rising because of a mix of food inflation, the way the food MSP might impact, and generally higher deficit? I mean, I think the borrowing program goes up rather steeply. Do you think all this will mean equity remains attractive to people whom you cater to?
Yeah, I mean, that's a lot of questions there, Lata.
Okay.
But let me put it this way. I think, as far as the attractiveness of mutual funds are concerned, what we've seen is that there's been certainly a significant, inflow in recent times. And that's also partly been because of the fact that people have gone looking for better returns, and some of the alternative asset classes have not been providing attractive returns. So while we need to see the fine print of what the changes in the tax law mean, I'm not sure that the attractiveness of the asset class has been dramatically reduced relative to what the other asset classes are providing. So I do expect that, there may be a little bit of rethink. People may have to rejig some of their thought processes. Particularly remember that this dividend distribution on equity-oriented schemes is something new, so we'll have to see what the implications of that are for some categories of investors or certain kinds of schemes. But overall, I think the relative attractiveness of equities and equity-oriented schemes will continue, and therefore I don't really see a very damaging impact on flows at all. I think, it should pretty much continue the way it's been.
All right. I mean, and the market seems to be continuing along 60, 61 points still on the Nifty, so looking pretty okay. Ajay, come in on your first take on, I mean, the budget itself. I mean, how would you see it? And two specific points. The point about the fiscal deficit being higher than what they said it will be, and the long-term capital gains tax finding a mention, 10% with grandfathering.
So I think it's a great relief today, the feel that, you know, the entire amount of gains that we all have made in the last bull run is all safeguarded with zero tax. I think it's been a great relief to that extent. Okay, whatever comes in the future, we will see to that. But at least this much money is now secured from tax-free. I think that's one of the greatest things which has come out of this swing. So uncertainty is over. We are sure that all the earnings we have booked so far in lying in our books as equities is now tax-free. It's a great relief, believe me, to all the investors that we speak about, including ourselves. That's one. Number two is, we love these kind of budgets. You know, as a financial community, love it because there's lots of things you're talking to the voters without spending the money. Okay. Let's say two biggest ones. 1.5 times the cost of thing is going to happen next year and will be accounted to the next year's budget. So we don't want to spend this money this year, so we are fine with that. Health insurance, I think we heard the allocation was nothing very substantial. My people tell me it's a few thousand crore, not some gigantic amount of health insurance money. So nice sounding scheme, no money being spent. Addressing the voters, we are good with that. So I think by and large, from the equity standpoint, your gains are safeguarded. Government is talking a lot of scheme addressing the voters, which is the fight to election. And let's not, you know, we look at the fact that today we are looking at the budget in the light of the Rajasthan by-election, which are going on at this point of time. So political compulsion on MSME, farmers, seemingly getting addressed by the government, at least on the face of it. If the content can be somewhat different than what the narrative is, that's fine. But at least this is being addressed, because this was the Achilles heel of this government, the MSME disaster and the rural India. Trying to address it without spending too much of money, I don't think we could have asked for it more.
Okay, markets have taken the budget extremely positively. The grandfathering of the capital gains perhaps has gone down extremely well with equity investors. And at the moment, they're not terribly worried about the fiscal deficit. We are speaking to a galaxy of stock market veterans here with us. Vetri Subramaniam, Ashwini Agarwal, Ajay Srivastava, and now Nilesha and Nilesha are with us. Thank you very much, both of you, for joining us. Well, Vetri, I just want to quickly ask you, we never got your overall comment on the budget, both as an equity investor and generally as an economy watcher.
Yeah, I think it's a budget which has its heart in the right place. As the finance minister said right at the beginning, this budget is really targeted more at the ease of living, as he put it. And I think, to be fair, as we transition more and more towards a market-based economy, we have to recognize that there are large sections of the population which don't have equal opportunities to participate in this economy. There are large sections of society which have been marginalized. And while it's easy to be cynical and say this is just merely an election year budget, I'd like to think that it's something more than that, that it is genuinely an attempt by the government to make sure that it is, targeting its spending at constituents of the population who are not really getting the benefits of some of the growth that the economy has been enjoying. So I think the heart is pretty much in the right place. The trick, as always in any of this, is in execution and in delivery. The country has never been short of, programs intended to deliver benefits to some of these constituents. Unfortunately, execution has sometimes been shoddy. It has been poor. The outcomes have been far less than desirable. But I think, we have to give the government a chance to do what it needs to be done as far as, the economically weaker sections are concerned. And I think it's also going to be the trajectory of budget statements going ahead, Lata, which is that, I think budgets of the past, which were seen as very big capital market moving events, that's now behind us. Indirect taxes are in the realm of GST. By next year, we'll have a new direct taxes code. And, hopefully there won't be annual tinkering of all of this. And then really the government, message in every budget needs to be about how it will spend the rupee that's coming into its kitty. And increasingly, that will have to be stuff which is targeted at the social sector. So I think we need to stop focusing on the budget as being something which determines the course of equity markets, either in the short term or long term. We've seen it that way for too long. I think that link was broken a long time back, but increasingly with today's budget, I think that's the reality that should actually hit everybody.
Okay.
Okay.
I just wanted to say banks with large NPAs have a bit of an advantage. They get a set-off, which was 7.5% now for provisioning made, tax rebate. Now that is increased to 8.5%. So banks with large provisioning, a minor benefit.
Also, I mean, the market per se has come off. We were up 65 points before we took that break. We're up about 35 odd points or so.
The lesson is don't go to break.
Yeah, I mean, can't do that. But we are still up. I mean, it makes you wonder if the entire long-term capital gains was not in the budget at all, what would the market be doing? Because with 10%, the market is just doing absolutely fine. We have both the Nilesh's here in our studios. Nilesh, let me come to you first.
Nilesh of Envision, let me come.
Nilesh of Envision. What is your sense? Is the market reading this absolutely correctly and the reaction is fine?
Yeah, absolutely. I think the market is by and large treating this as not a very significant event. Yes, there is LTCG which has got introduced, but the fact that there's grandfathering and the 31st Jan as basically the baseline for prices, I think that's a fantastic thing. That provides a pretty solid cushion to what could have been a potential downside to the market. So I think that's the big positive.
No indexation, STT still stays. I mean,
I think that's still fine. I think
the fact, wouldn't it add
I mean, look at the worst case scenario where this could have been retrospective, which means on all your past investments and things of that kind.
Okay.
I think look at it from that perspective. And versus that, I think really this 10% with 31st Jan as the base, I think is a fantastic development. And I think that in a way cushions the downside for the markets. Two is on fiscal deficit. Election year, probably the fiscal deficit, he could have still 3.5, could have kept it at 3.5 saying, but he's not gone down that path. It's just 3.3% with no big bang ambitious targets on disinvestment. I think if he had kind of outlined a very ambitious target on disinvestment, I think the credibility to that fiscal deficit number could have been at risk. So I think these are some of the two things where there is really no negative, and that itself provides some kind of a cushion to the markets. In terms of otherwise growth, I think the assumption is that the GDP will grow at 7.2%. He's betting on better compliance, which will result into better buoyancy in tax collections. I think those are some of the positive things. So the way I look at it is that this is a very disciplined and a healthy budget, given the kind of focus on fiscal deficit, the focus on buoyancy, and the huge impetus it provides on the healthcare sector. I think that's really the big sector which benefits disproportionately from this budget.
Okay, Nilesh of Kotak, as an equity investor, you think the markets will go on partying?
So it depends upon your definition of party.
Last year was, 26%?
Yeah, but you haven't met some of my investors who were unhappy at 26% return also. Okay. So there will be always different kind of people, and by and large, I think we are in right direction.
Okay.
So equity market should continue to gather momentum, but please don't expect repetition of last year's performance. That's unlikely to happen this year.
Okay. Well, I wanted to ask Ashwini, you know, as a person who speaks to at least foreign investors and caters to them, what is your sense? Will this so-called reverse fiscal consolidation or reversal of fiscal consolidation, one, and two, the tax, will sell with, they'll be okay with it?
See, let's talk about fiscal consolidation first. I mean, the numbers that we are talking about, I mean, I tend to agree with Nilesha in the sense that you're talking about a 3.5% going to 3.3%. It's not staying at 3.5 or going to 3.8 in an election year. I mean, there is no large amount of money being thrown away at freebies that would win votes. I mean, I think what's being done is all very reasonable.
Yes.
The second thing is that the government is showing a great degree of confidence in its reforms on GST and the fact that they have a large number of new tax filers who I suppose the government expects will pay more taxes as we go along. And I think both these events, or at least these assumptions, show the confidence that the government has in its own taxation regime, the efficacy of the taxation regime, which I think is a very big positive. Coming to the long-term capital gains of 10%, it is a little bit of a disappointment in the sense that your expected returns from the market, if they were, let's say, in the region of 15–16%, now get shaved down by 1.5 percentage points or thereabouts. Does it rock the boat so hard that investors leave? Probably not. Does it make them less happy than they were? Probably by 10%. So, you know, it's not a big deal.
Oh, that's good to hear.
Well, there is a long, I mean, actually there are about 10 pages with which talk about changes to customs duty rates.
Yeah.
You know, there's all kinds of stuff from orange juice to cranberry juice. But two things. One, I don't know if he highlighted this. Truck and bus radial tires, I mean, customs duty has gone up from 10 to 15%. I mean, actually, I think stocks were reacting. Ashwini was also mentioning that earlier. So CA, JK, etc. They were all up 5-7%. On footwear as well, I mean, customs duty has gone up from 10 to 20%. So we got a couple of them listed. So maybe we could keep an eye out on those.
Okay. Well, I just wanted to ask, let me ask Ajay. Ajay, this big rural push. Okay, well, let me get Vetri in on this. Vetri, will you be positive on rural-based stocks now? Because the MSP, the way it's designed, is going to put more money into the hands of farmers.
Yeah, I'd say, Lata, you know, I think the PM already made his thought process clear on this a year ago when he talked about doubling, you know, farmers' incomes over the next 5 years. So I'd say some of the focus that we saw today and some of the specific, you know, things that we saw in terms of MSP plus 50% are really a continuation of that. In fact, if you actually recollect, the MSP plus 50% was actually in the BJP's manifesto of the 2014 election.
Vetri, I will have to interrupt you. I'm very sorry. I know that's also the Swaminathan Committee's report. But my colleague is talking to Adya. Maybe we want to just hear out what the Finance Secretary has to say.
Capital gains tax. It has been reintroduced. A lot of investments will now be taxed under this. What was the idea behind this and how would it benefit the government and especially try and get people, those who were outside the tax net?
The question is that do we encourage one type of investment in one class of asset vis-a-vis all other classes of asset, or do we try to balance them? When the long-term capital gain tax was removed from the country in 2004-05, the circumstances were completely different. We wanted to encourage the capital market. There was also an issue of foreign companies not paying any tax, and that's why we thought that instead of doing disfavor to the domestic investor vis-a-vis FII, we give equal treatment to all. But all these measures of keeping it outside the tax net has now paid off. The tax market is very, very buoyant. Even with 10% tax, the gains from equity will still be very attractive for market. And so this is the right time to bring it back into the tax net. There is no reason why we can exclude a large chunk of income earned by people of about 3.67 lakh crore in the last year out of the tax net. So we thought, let's make a beginning, and without heating the market too badly, we have done it in a very soft manner, and I think the market has received it very well. I don't think there's any problem.
So, talking of the fiscal deficit targets, which have been increased for this year to 3.3 and later on to 3.5 and then 3.3. So, when we talk of the revenue decline that we are seeing through because of GST and an increase in the expenditure, how do you plan to make up for the revenue decline for this fiscal? And what do you think should be a realistic target for the next fiscal also?
Well, we have given the target for the next fiscal. 3.3 is what we'll be able to reasonably meet with. But again, we have always been cautious in our budgeting exercise. We don't want to overestimate our revenue and we don't want to underestimate our expenditure. The reason why we have always succeeded in having expenditure more than...
Okay, we will get to what Mr. Adya is saying. Though it is a tall revenue expenditure assumption, 17% higher gross tax revenues have been assumed, and 10% corporate tax, 20% income tax, and almost a doubling of GST income, or at least 60% higher. Nilesh, at the end of the budget, what sectors will you prefer?
I think the big sector is clearly healthcare. I think this universal health protection scheme, I mean, of course, one doesn't really know the exact details of that, but I think it's truly universal. When you're trying to cover 10 crore families, 50 crore people, I mean, that's almost 40-50% of the population of the country. I mean, that really comes into the entire net in terms of providing healthcare services. I think it means a lot. It means a lot for hospitals, especially in tier 2, tier 3 cities. It will mean a lot for some of the other chain of pathology labs. It will mean a lot for even the domestic formulations. I think you're going to see now more and more Indians having affordable medicine. So clearly healthcare as a sector, according to me, is really the very big beneficiary of this budget.
All right, gentlemen, on that
the
note,
market is in the red, by the way. We were up 60 points. We're down 10 points.
Oh, yes. The last 1 hour could be very crucial, and Anuj and Surabhi will be here. We are taking a quick break, and I think now the markets deserve much more attention.